So we're going to dive right in. And when we start, we're looking at some of the global assumptions and what the general economic outlook for the region is going to be. Now, the overall EMEA growth will likely ease in 2022 compared to last year. This is mainly driven by that downwards revision we undertook to Western Europe and also Russia, directly caused, of course, by the current conflict. And in the meantime, we do expect growth in Middle East, North Africa region to continue to gradually accelerate, driven by the stronger post-COVID private confidence, the resumption of public projects, and also higher commodity prices. While most markets are returning to their pre-pandemic economic shape throughout this year, countries like Iraq, Algeria, Lebanon, and Iran will unfortunately need more years, or 1 or 2 more years perhaps, to reach that pre-pandemic economic size and within that level. While Egypt's economy, the only one that didn't actually see any GDP contraction in 2020, will remain significantly larger than pre-pandemic levels due to that starting point and the growth that it was able to maintain throughout the last 2.5 years. However, with consumer habits having changed, with business margins having been pressured, and with governments facing higher debt levels coming out of the pandemic, capturing new opportunities in 2022 will require nuanced strategies, and we will take you through the details of all of that today. Now, costs in 2022 will be at the forefront of challenges weighing on purchasing powers and softening some of the potential of economic recovery. Some countries will face or will feel rather the inflation bite more than others. Businesses will also continue to feel that margin pressure, and households will remain quite price sensitive throughout the year. Now, an array of cost pressures will result. In this, you've got fertilizer prices are growing on the back of natural gas shortages, supply disruptions, and the nitrate export disruptions from Russia and Ukraine. And consequently, food prices will remain high through the year, and further made worse by the fact that we are seeing some disruptions to wheat exports from Russia and Ukraine. Of course, different countries have a different level of reliance on exports of wheat and grain coming from Russia and Ukraine. However, the overall global prices are going up, and that will trickle through to almost all of the markets. Now, the COVID disruptions, the shortages, and other logistic imbalances are also prolonging the severely high price environment in shipping. As demand continues to recover in 2022, particularly when we think of the second half of the year, it's only going to pile more pressure on the shipping line capacities and that already quite long backlog of deliveries. Thus, we are emphasizing the importance of factoring in to our budgets the additional costs for the year. And of course, with oil prices, we have raised and revised up our oil prices shortly after the invasion of Ukraine began. We are forecasting an annual average of about $89 to $90 per barrel for 2022. That's an average for the year. But of course, that is conditional on how severe the immediate term energy supply volatility from Russia is. We could revise up prices further should we see a complete and prolonged energy ban, export ban essentially from Russia. Of course, prices today and tomorrow will look very different. Spot prices will remain quite elevated in the immediate term, driven largely by that risk premium, which is stemming from the fears of how long supply disruptions could last for, and of course, as we mentioned, how severe and prolonged potential bans could be. Now, in the second half of the year, we are expecting to see upwards pushing risk premiums to start to subside, and we are expecting to see OPEC continue the gradual increase of supply to the market. Of course, the OPEC position still remains to be the same even before the invasion began in terms of gradually widening the overall supply to the market. Essentially, OPEC does not want to create too much of a situation where we have low prices. It wants to keep prices stable, and it wants to keep supply stable. The recent news that came out of the UAE signaling their intention and their support for, raising a little bit further the supply to the market, that has eased some of the concerns and some of the fears, and especially that the factors that have pushed up oil prices to the highs that we saw, about $130. And now we're seeing that soften a little bit today. I believe the prices came down to about $105 per barrel. So OPEC position remains the same, but there is a commitment to keep supply stable and to keep prices as stable as possible. Now, more critically, gas prices have also spiked rather significantly. Prices will ease very slightly with the falling seasonal demand in summer. However, the issue here is that supply disruptions and the sanction complications, those risk insufficient or very expensive build-up of inventory in the summer. And what this means is that companies essentially are likely to buy a lot less. Energy companies are likely to buy a lot less gas through the summer because of that higher price. And this leaves us in a situation where we have leaner inventories into Q4 as we go into the next winter period. And that does raise the probability of higher gas prices remaining with us in the fourth quarter of this year and also early 23. Now, so far we've explored the base case scenarios. However, should we see an escalation in the current conflict, further disruptions to Russian gas exports and/or a failure to secure an Iranian nuclear deal, then oil prices will spike even further and will remain high for the remainder of the year and also early 2023. So essentially what would happen is that the episode of softening of prices will simply be delayed further and further. Now, it is important to note here that at Frontier View, we do believe that Brent crude oil prices are unlikely to stay significantly high for a significant period of time. I mean, when we saw the $130 per barrel at these rates, not only would demand destruction occur, but we would also expect to see some further reaction from OPEC, essentially seeing additional supply coming online. And as we mentioned earlier, we've seen that signal from some OPEC members, and we've also seen US shale production slowly increasing in the last few days in order to counter that pricing situation. Now, if we dissect the Russian-Ukrainian conflict, we start to see there's a little bit more light on the extent of damage the conflict may cause on global costs. The three parties involved, invaded Ukraine, sanctioned Russia, and Belarus, account for a sizable portion of the essential commodity supply into the global markets. And we're not here just speaking about wheat and energy. Now, of course, many of these commodities provide material that go directly into manufacturing, into food products, into food processing, into health treatments, and more. And essentially, any changes to supplies will directly cause costs for multinationals and for producers to spike and create potential disruptions to the manufacturing activity across Europe, which would essentially create a downstream negative impact on MENA countries, which tend to supply the European manufacturing scene. And the Middle East and North Africa region in particular is quite vulnerable and reliant on those three countries for numerous commodities, meaning that inflation will certainly exacerbate challenges and across the region rather for the coming 12 months. And you can see here on the slide, everything that is covered in green essentially are markets from the Middle East and North Africa region. And you can see just how spread they are. In fact, going into 2022, we had raised our inflation outlook globally, mostly, of course, driven by the pickup in costs discussed earlier. However, the latest conflict has further exacerbated the cost pressures, and we have embarked on a second wave of upwards inflationary revisions. Now, higher operational costs will continue to trickle through into consumer prices for the coming 6 to 9 months. Thereon, we do expect to see a softening of prices, but that trend will only be gradual. So we won't see a quick normalization in pricing anytime soon. Some markets, of course, will feel these pressures more, particularly when you have currency volatility or severely vulnerable countries and exposure to commodity prices. For example, Iran and Lebanon's currency volatility will leave them with severe hyperinflation rates in 22, with Egypt's high reliance on commodity imports, we expect to see inflation staying relatively elevated also through the year.
Hi, my name is Krista Reganey, and I'm Marketing Director here at FrontierView. I'd like to thank you for watching a segment of this webinar. If you'd like access to the full video and our latest insights, data, and research, sign up for a free trial with us today. Simply scan the QR code on the screen.